being said, I'd like to go into the segment on the U.S. market and the economy. Stacy, if we can go to the next slide. And this will be a great opportunity for Ryan and Marty to share some more information.
So when we look at making decisions from the portfolio's perspective, what we always stress is looking at the fundamentals, right? So fundamentals of corporations and their profits, fundamentals of the economy, and where we see those fundamentals going, and what is the general direction or momentum that we see. Before I quickly get that slide, just to highlight some elements, it's interesting because how the mentality changed from the last quarter of 2013, where we saw some clients wanting to take on more risk, right? Hey, market's doing well, I want to take on more risk. And we try to counsel and say, you know what, that's maybe not a great idea, and let's think long term on this. And then we hit in January, and all of a sudden that sentiment turned real quickly. When a lot of the news has been pretty good. So we had GDP growth of 3.2% in the fourth quarter, which is certainly above the new average normal that was supposed to be 2%. We had increasing housing prices, that is one of the largest increases we've seen in a while. We have had earnings. 50% of the companies that have come out with earnings have been above expectations for both revenue and profits. And we had consumer confidence that came out with a level that was higher than anything we've seen since the summer. So what's important to remember is that sentiment that can kind of flow through the markets and flow through in particular the news media that influences us all. It can change very quickly, but where do the fundamentals lie? And there are a few weaknesses, in particular on the retail side, some of the reports in a manufacturing number as well. But we're looking at the more macro picture and what we think are going to drive things. So we're going to walk you through some of the big elements that we think really are going to be supporting economic growth, both in 2014 and even the next couple of years. So one of the big pieces that was very strong last year was housing. So we can see here, this is housing starts going back to 1994. And of course, you can see the bubble that occurred from 04 to 08, and then the dramatic decline. And as you can see, even with some of the improvement we've had, we really dug ourselves quite a hole. And when you look at some of the statistics, in particular on what's called household formation, so that is when individuals, they leave their parents' house, they leave college, and they start their own household. They buy a house, they buy a condo. That creation rate has been below what our increase in population has. So we're adding more people through immigration to our country, and our household formation rate doesn't even cover that. So that's been the case over the last 5 or 6 years. And I don't think any of us wanted to go to the peak that we saw in 04, 08, but there's a good chance that you're going to see a lot more housing starts, or certainly not a decline given that fact, right? Which is, at some point, the kids move out of the house and they start their own household. So that is definitely one factor when you look at that job creation. As you've got people building homes, it creates a lot of additional homes. Or if they buy a home, they're going out and buying a lot of additional goods and services. So that's a real strong job creator that we saw last year, and we're probably going to see this year, even with interest rates a little bit higher than they were in 2013. Next.
All right, great. So this next slide is going to show us some of the strengths in U.S. large cap companies and how well they're performing, given that over the last couple of years we've seen really slow growth in the economy, as Marty alluded to, about roughly 2% for a number of years, which overall is very slow growth from what we're typically seeing. On the left side, we have earnings per share. Right now, U.S. large cap corporations are at their all-time high, right around $26 per share in their earnings, which is a very high number considering the slow growth in the economy. Top right, we see the profit margins. Right now, companies are operating super efficiently. There's not a lot of room to grow in terms of their profit margins here, but we're seeing that they've really slimmed down and they're operating really sleekly to make up for some of the slow growth. And bottom left, we're seeing what the total leverage is. So over time, the average historically has been about 1.7 debt to equity ratio. So that's measuring a company's liabilities divided by their shareholder equity. Right now, at the peak, right around 2008, 2009, companies had over 200% what their debt to equity was. So they were super leveraged or borrowing a lot, trying to borrow to create growth. Right now, companies are about 1-to-1 ratio debt to equity, showing that they don't have to borrow as much to earn these high rates of return as we see in the earnings per share. So it's a really positive sign with these U.S. large caps. Next slide, please.
So when we go through, we're looking at different sectors and where we're going to see growth that perhaps we haven't seen growth before. And one part is on the capital goods expenditures. So this slide may look a little confusing, but I'll explain it. So basically, with the yellow line, that is the net stock of equipment value. And what you can see is it's very low. So it's one of the lowest it's been. But the age of the equipment is increasing. So what you can see is over time, from 1960, we have these patterns where the equipment gets very old, and then companies start investing in capital equipment. Because at some point, that computer, that car, whatever that equipment is, you have to replace it because it's going to fall apart on you. And the fact is, if you want to continue to either increase revenue or continue in your revenue stream, at some point you need to invest. So as we hit those peaks, what usually happens at that is you start having companies spend on capital expenditures. And that piece has been missing from GDP over the last probably 5, 6, 7 years. Companies have not been spending on capital expenditures. And when that piece starts to kick in, again, when you think about it, it doesn't have to go full force, it just has to kind of come off the bottom from where it's been. And that can be a real plus to economic growth in the US. Next. The other element, as far as the components of GDP that have been a weakness in the last several years, is government spending and basic taxes. So this basically shows you that starting in 2009, you're looking at the fiscal deficit that was as a percentage of GDP. So you can see we ran huge deficits in 2009, and certainly some of that helped to the extent that was stimulus that was put into the economy. Whether or not that was good stimulus or whatever, that's to be debated. But the fact is that was money that was put into the economy to help stimulate growth. But it was also becomes a huge burden on the economy as well. So as you can see, through increases in taxes, so the tax rates have gone up in a number of situations, and improvements in the economy, and also reductions in expenditures. From a federal government perspective, and even in local state governments, expenditures have come down dramatically from where they were 5 or 10 years ago. That percentage of deficit, annual deficit versus annual GDP has declined dramatically. So even last year, with the higher tax rate that was in place and the spending cuts that were put in place for both local, state, and federal government, that was a negative to GDP growth, right? So even though the private sector was growing, it was being reduced over the last several years by reduction in government spending and higher taxes. So 2014 could be one of the first years we've had in a while where government spending is either going to plateau or could actually start going up, right? You hear of different states that are having surpluses. Now, what do they do with that surplus, we'll see, but a situation where they're not cutting spending. And again, when you look at the different components, you want to be looking at components that can provide growth to GDP, and one of them we're seeing is government spending, on pretty much in every level versus what we saw in prior years. Next. A really big story that we have in the U.S. is our energy industry. Both natural gas and oil are reaching all-time high productions. So what this is showing you is our U.S. crude oil production. That's the orange yellowish line. And you can see it was been declining for years. And then just recently, it has just skyrocketed up. And where it's going to go from here, we can literally, in about 10 years, be the largest producer of oil and the largest producer of natural gas. And you can see our oil imports have declined dramatically. So both from production and growth in GDP, that growth in that industry is going to be tremendous. And also in lowering cost for manufacturing and other businesses or consumers. That's a real plus. So I think we need to be aware of what is that going to provide as far as a tailwind to the U.S. economy, both in this year and in out years. Next.
And the energy story that Marty's bringing up also leads us to another success story in the U.S. right now, and that's U.S. manufacturing. So given a number of different elements, whether globally or in the U.S., we're seeing U.S. manufacturing coming back to this country, a lot more goods being produced right here. Part of that is a restrained U.S. labor cost. We've seen wages stay pretty stagnant over the last couple of years. part of it due to the recession, and so it's a lot cheaper to produce these goods in the U.S. Emerging markets wage increases. As emerging markets are evolving, they're seeing their labor costs increase. So that's increasing goods to produce overseas. Now we're starting to bring them back here. Abundant energy, low natural gas prices, big driver in terms of producing goods here. U.S. dollar's reserve currency status is really helping us bring these goods back here rather than pay for them overseas. Made in America bias, world-renowned higher education. A lot of the rules and laws, whether it's accounting, whether it's just government regulation overseas, it's a little trickier to work with, and that drives up costs. So bringing it back to the U.S. is helping drive some of these companies to manufacture their goods right here in the U.S. Next slide, Stacey.
So the last 3 quarters really, in particular the manufacturing sector, was a real change from what we've seen since the late 1940s. So we had 3 consecutive quarters of growth in the manufacturing sector. And what's important to remember now is, unlike what was the case in the 1940s and 50s, the manufacturing sector, by default, the fact we've had all that decline, is now a much smaller percentage of our gross domestic product. But the fact that we've had 3 quarters of growth in that sector is a real change. Obviously, that hasn't occurred since the 1940s. And again, it's something where we're seeing more of a tailwind pushing and supporting the economic growth versus something that's pulling it back. And there are, as Ryan mentioned, there are a number of factors that are supporting that growth. And our expectation is, again, you have to remember there's going to be fits and starts. It's not all going to be straight up. But overall, that trend is something that we're probably going to see continue. And really, the term is onshoring, where they bring, instead of putting it offshore, they're bringing the jobs back. And that's probably going to be something we can continue to see happen. Next.
The big question we're seeing now, and it's been coming up, I think, all year almost, is the market overvalued? We're seeing, we're seeing sentiment really high, investors coming back into the market, and where does that lead us? Are we getting to, points in previous bull markets where we hit a peak and we see a crash? Are we reaching a bubble? Some of these numbers here, I think, really dictate that. It may be a little bit more overvalued than it has been in the last 4 or 5 years, but overall, we're really at a good point in terms of the fundamentals and the price-to-earnings ratio. Right here we have 10 previous bull market peaks, and over this time, the trailing PE ratio on average has been 18.7. Right now, our trailing PE ratio is only 16.6. The forward PE ratio for the majority of the peaks of the bull markets after 1980 averaged just about 17.1. Right now, we're only at 14.8. So, looking at, and these are all part of the fundamental analysis that we do when we're looking at indexes and asset classes. And right now, we see that although they're valued a little bit higher than they have been recently, there's still some room to grow, and they're still reasonably priced and valued overall. Next slide, please.
So one of the things to remember is, we've had such strong growth of the market last year. As we've mentioned, the fact that if the market's up 32%, and you happen to get a pullback of 5 or even 10%, that's something that should be expected as investors. And certainly, again, it's amazing how quickly your mindset can change, which is, after a year like last year, it should be all straight up, right? That's the way the market's going to go. But the fact of the matter is, the more those valuations get stretched a little bit, you're going to have more volatility. And certainly that's what we saw, in the last 3 weeks plus. And what you can see with this graph is the red line means the market's kind of overbought, that maybe the valuations are getting a little stretched. The green line moving up is where the markets are actually becoming oversold. So really, we're coming at a point where the markets are oversold a little bit. And again, markets don't move always with an element of rationality, right? So they can definitely overshoot and undershoot. And so it doesn't mean that because it's showing that in the graph that it should go up, but it does mean that at some point here, we're going to get to a point where, investors are going to start saying, I want to buy in at that. And so for long-term investors, like all of us, it's important to understand where does that volatility stand and where we stand as far as valuations, as Ryan was saying. And is the market maybe oversold or overbought? And in our perspective right now, it's getting to the point of being oversold. Next.